nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Savant, and with me, of course, is Eric Palmer. And we're sitting here talking about a new product called Second to Die, or Survivorship. You can call us 1-800-290-7226 or write us at our email address, thequest@brokersalliance.com. That's quest@brokersalliance.com. And we're going to talk about this whole thing about 2 lives on 1 contract. Well, in the annals of tax history, 30 years ago, I don't know if it was 30 years ago today, but it was 30 years, some odd change, calendar day, where the government decided to give us this thing called the Marital Deduction Act. In the old days, when Dad died, he passed on his inheritance to his wife and children, but the wife had to pay taxes on it. Now, 30 years ago, they changed that, so it passes from whoever dies first, mother or father, we don't know, but generally Dad. He dies first, and then he hands it over to his wife, and that exchange goes free. So I really enjoy the Marital Deduction Act. Now, then a Canadian company, I think it was, I don't want to say who it is, but you know, because they're not there anymore, but they invented this thing called Second to Die. Since taxes weren't due until the second to death after the Marital Deduction Act, therefore, they didn't pay the claim on Second to Die. And I remember clearly 30 years ago somebody saying, this is a loser product and it will never go anywhere.
Right.
And of course now we know it's one of the big estate planning tools. It couldn't be one, it's really one of the most reconciliatory products we have out there because it can fix a lot of issues. Now, before we get into what it can fix, we're talking about Second to Die. And again, here we go again this whole week. We're talking about universal life, whole life, index. I mean, you name the chassis, Second to Die works on it. And remember, it pays on the second death. So the price tag per thousand is so much cheaper than individual insurance. Males are more expensive. Females are less expensive. Second to Die, especially if both people are healthy, are even less expensive than that. So talk a little bit about that, Eric.
Yeah, well, it's balancing the 2 lives in the underwriting scenario versus individual lives. So if mom and dad went out individually and bought policies, you know, mom plus dad would equal X amount of premium. Well, they're taking those 2 lives into consideration. So mom's actually helping dad out a little bit because her life expectancy is longer. She's probably, in the eyes of the actuaries and the insurance company, a little bit healthier. So that the combination of those 2 health risks drop that premium combined. So instead of buying 2 policies separately, you can buy the 1 survivorship policy for a much lower cost. And it's based on the second life, or the youngest individual in the policy. So what they're really looking at is, you know, if mom is 5 years younger than dad, you know, she's really the driving force there, and it's the second person in the contract to die that triggers that death benefit being paid out.
Well, I'm looking at the top 10 survivorship guaranteed universal life, just to get a kind of an idea on the numbers. Now, I want to say that in 1990, when we really got into selling Second to Die, which is 2 lives on 1 contract, the prevailing premium was $25,000 annual premium for $1 million worth of coverage for a 65-year-old male and female. Now I'm looking at the same 65-year-old, right? It's if they're both super preferred, I'm looking at a number of 9,327, you're talking about 13, 14 years, that number has went from 25K to 9,300 and change. That blows my mind. And even if the clients were both standard Americans, just average American health,
right,
that premium is $12,000. And you say, well, still sounds like a lot. Well, yeah, but if you're looking for $1 million of coverage for your estate planning, your charitable giving, your legacy creation, your giving to your children, right? I mean, all this could, and grandchildren for sure. This all matters. But look at these numbers. I mean, we're at 90, and this is guaranteed, by the way, 9,300 and change for $1 million Second to Die. And Eric, I got to ask you about this, because this blows my mind. And I just gave you the standard number, which is at $12,000. Because of the way they price this product, you could even take an uninsurable? I mean, the guy's totally declined.
Yeah, I was actually going to point that out. That's probably one of the most effective applications of this product. Is a lot of times we come across, we're looking at the two spouses. We're trying to determine what most appropriate insurance is available, and we come to find out that one of them has a significant health impairment. I'm talking, potentially an extreme cardiac issue that happened within the last 6 to 12 months. It puts them into a situation where we just can't get an offer. That individual plus the healthy spouse could still result in an offer for a policy, and the healthy spouse is really the driving force there, because remember, it's second to die. So if you have an uninsurable individual and they pass away, the insurance company's still looking at the more healthy individual because they're going to live longer, and that's what they're basing the premium on. So it's a little bit more expensive in that situation, but they're basing it on the healthy individual anyway as far as when they're actually going to pay out that claim. So I think that's probably one of the most significant ways to position this product is look at those individuals that you were declined a policy for and talk about survivorship insurance. Let's get mom and dad on the policy and still provide that insurance for the estate.
It's possible, depending upon this issue called, you have to have financial suitability. There has to be insurability. I just can't buy it on somebody and I have no economic ties to them. But maybe somebody inside my family that we all have some kind of vested interest. And let's say mom was really sick and dad was uninsurable. Maybe I could put on mom's sister, who maybe has a similar timeline. Remember, you have to measure, and Eric and his team does all this for you. We can measure whether we're using the 2001 CSO tables, which is a mortality table for standard Americans, non-smokers, or whether we're using the Society of Actuaries value-based technology. These tables that they have, the 2008, they're pretty recent.
Right.
You can kind of, in between, somewhere in between is the reality, and we try to use them both because it's kind of like a booking quote. And sometimes we might be able to, based on insurability interest, remember we have to have financial insurability, I need to make sure that and the suitability has to be there so that I can place maybe another member of the family on, as long as it's blood relative and there's a reason to justify it.
Right. And we look at ownership issues there too, because anytime we go outside of the mom and dad structure, the parents and the children and the beneficiaries, anybody we bring in, a third party, even if we do have the ability to justify the insurability, we want to make sure that we have the appropriate structure for ownership and beneficiaries, because we want to make sure that there's no other events in the future that could possibly affect whether or not you want your sister to be part owner of a policy or partly on a policy with you. So there's a lot of questions to ask there, and there's very specific ways to set up the ownership. Possibly we involve a trust, but again, that's one of the advantages. The bigger the case, but the advantages again to working with Brokers Alliance is that our team really takes all that into play when we're looking at these things.
When we look at survivorship, or second to die, or as I euphemistically like to call it, last man out, right? When I look at these contracts, there's so many. We're looking at guaranteed UL, assumption UL, index UL, variable, whole life. I mean, there's so many different forms. We look at all these contracts and really do our due diligence, not only in the carrier ratings and the balance sheet issues of the financial balance sheet of those carriers, the life insurance companies, but we're looking at the contracts, the writers that are on there. Some of these will
or the way they're calculating their interest. I mean, you could have 4 different index universal life contracts, sit them all side by side, and the features might check off the same. But when you really look at the way they're calculating the rate of return on their illustrations, you might be appalled that all 4 of them are doing it completely different. So we want to make sure that we analyze all of them. We put the best options on the table and the most realistic options on the tables, because we want to make sure that the policies do what we're illustrating and or come close to what we're illustrating. Even on the current assumption side of things, where the interest rates are more fixed, there's companies out there that are offering in the 5s on current interest rates versus some of those that are only offering about 3.5% right now. So we're going to put all those options on the table, because we want to be the most competitive for you and your clients.
I sometimes like to look at the history of the, not only what they're currently crediting, which you just said, but I'd like to know what their history, what's been their track record. What's the pattern of behavior on the way these carriers have credited?
Especially with whole life and dividends. I mean, you can look back at the dividend history of an insurance company and tell whether or not that company has been, conservative forever, or maybe recently they just took a conservative mindset because they had investment loss, say, 10, 12 years ago. That will be reflected in that rate history, and it's really important to look at that data.
And we don't want you to manage that issue. That's why
That's our job.
you have advisors to do that. And many people, like I said, we distribute this show to about 250,000 through a major distribution channel to producers and financial advisors. And, of course, we go way deeper than we're talking around the air, and we really manage this issue. But we have comparison spreadsheets on survivorship. On any of these chassis that we're talking about, we look at all these carriers and to see which we think will benefit our client in the long haul. Now, we know that the estate plan, or actually the estate tax issues just changed, and it was deferred for about a couple of years. So for the next 2 years, some people are going to look at a wait and see, kind of see what happens. Other people are going ahead and buying minimum premiums.
That's a great point, Steve. Especially with survivorship right now, a lot of us are saying, well, it's a $10 million exemption. Let's just wait and see what happens. Well, in 2 years' time, you could develop a health condition and make yourself uninsurable, or just make those premiums that much more expensive. Or let's say your health didn't change. Remember, in 2 years, that same super preferred non-tobacco rate will increase in cost. So lock in your insurability now, and we can fund just the very, very bare bones of premium for the next 2 years, so that you're not shelling out too much cash, but we've locked in your insurability. If they increase or decrease at that point in 2 years from now, the estate tax exemptions, we can buy more or reduce the amount of insurance we have, but we've got you covered for now. We don't want to just sit on the sideline and wait. That's the worst thing that you could do, because, again, there's too many what-ifs that could come into play that can completely destroy our plan.
And then, you know, a lot of these contracts are flexible enough that if you bought the minimum, you could backfill or pay past premiums to kind of catch up.
We could do a skip premium, exactly. Put just enough in today, not pay premiums for 2 years, and then start catching up the premiums later on.
Well, all this week we've been talking about life insurance because it's the product that says I love you. And we've been doing our tribute to Valentine's Day and all this week. And I'm hoping that you're seeing some pattern develop here on the show where you see that we try to talk about everything kind of in the generic. But for your specific situation, feel free to contact us. Over with Eric at Brokers Alliance, at thequest@brokersalliance.com. We'll make sure that gets to him, as well as you can call him 1-800-290-7226. Whether it's term insurance, you can do the quotes on that. If you haven't had a policy review, this is the time to do it. We're looking at term that goes 10, 15, 20, 30, 40-year, guaranteed UL, current UL, index UL.
And it doesn't cost the client a thing.
Doesn't cost you a thing to do the due diligence.
Right.
That's the best part about the whole thing. Well, listen, I want to thank you, Eric, for being on our show. Our sponsor, Brokers Alliance, and America, where anyone can go on a quest for financial freedom.